Welcome to the Opening Bell Report.
I have to admit, when I first pulled up the terminal this morning to prep for today, I had a moment of, well, genuine sticker shock.
Oh, I think everyone did.
Right, because, we are used to seeing big numbers in tech, usually regarding valuation or revenue growth or whatever. But when you see a net loss of $1.1 billion for a single quarter, that stops you in your tracks.
You talk about Opendoor's Q4 report.
I am. Yeah, specifically that headline number, the $1.1 billion loss. I mean, if you are just scanning the wires or looking at a notification on your phone, that looks like an absolute catastrophe.
It's terrible.
It looks like a business model that has just fundamentally broken. My first thought was, okay, the housing market is cold right now, but are things really this bad?
Yeah, it's the kind of number that triggers an immediate emotional response, right? It screams, sell everything, get out. But this is exactly why we do these deep dives for you guys listening. Because if you stop at the headline, you are entirely missing the actual story. In fact, you might be missing the entire investment thesis.
Well, that's the exact tension we need to resolve today. I've got this analysis report right in front of us. It's titled Opendoor 2.0, The Blueprint for a Housing Recovery.
A very telling title.
It really is. And the central argument here seems to be that this billion-dollar loss isn't a death knell at all. It's actually a sign that the worst is over, which honestly feels like a massive contradiction.
I know.
How do you square a 10-figure loss with a bullish turnaround story?
It does sound contradictory at first glance, but when you parse the analysis report, it really becomes a story of accounting mechanics versus operational reality.
Okay.
Our mission today is to separate that headline shock, which is that massive billion-dollar figure, from the underlying reality of the business. Because the analysis suggests that Opendoor has fundamentally changed its engine while everyone else was just staring at the paint job.
Okay, let's pop the hood then. We have to start with that $1.1 billion hole. I consider myself fairly seasoned.
They used a significant portion of their cash to just clear out future liabilities.
Oh.
The report describes this specifically as de-risking the balance sheet.
But play devil's advocate with me here for a minute.
Sure.
We know the housing market is precarious. Interest rates are still elevated. Volume is low everywhere. Is it actually smart to use nearly $1 billion of liquidity just to pay off debt early?
That's a fair question.
Doesn't that leave them with way less runway if the market stays frozen for, say, another 2 years?
That is the exact right question to ask. It's a trade-off. But the analysis argues that by taking this hit now, by tearing the Band-Aid off, as they put it, they remove the looming threat of debt maturity walls altogether.
Okay.
It cleans up the books so that future earnings aren't constantly weighed down by heavy interest payments or the risk of having to refinance at terrible rates. It's incredibly painful in the short term, hence the ugly headline, but it sets the stage for a much cleaner financial future.
So it's essentially a kitchen sink quarter.
Yes, exactly.
They are taking all the pain at once right now, so they can show a clean face to investors next year.
They are drawing a line in the sand. But listen, there's another number in here that I think warrants just as much scrutiny as the net loss, and that is the revenue.
I was just about to go there, because revenue came in at $736 million, which is down 32% year over year.
A massive drop.
A one-third drop in top-line revenue. Even if the debt payment explains the billion-dollar loss, doesn't a 32% revenue drop signal a shrinking business? How on earth do you spin that as a positive?
Well, you don't spin it as a positive necessarily. You frame it as a necessary correction.
Okay.
The report emphasizes that this revenue decline was actually intentional. You have to remember what Opendoor was sitting on.
Right.
They had what the analysis calls toxic legacy homes.
This is the bad vintage inventory, right? The homes they bought during the absolute peak of the bubble before the Fed started hiking rates.
Precisely. Look, if you are a home flipper, which at scale is essentially what Opendoor is, inventory is like produce. It spoils.
That's a good analogy.
Opendoor had a warehouse full of spoiling inventory that they bought at 2022 or 2023 prices. To move forward at all, they had to flush that system.
So the revenue drop is them basically refusing to buy new bad inventory just to keep the top line looking pretty for Wall Street.
Correct. They purposely shrank their buying volume over the last year to focus entirely on selling off the mistakes of the past. They sacrificed size for hygiene.
Hygiene over size.
Yeah. The report argues that if they had tried to maintain that previous revenue growth, they would have just been compounding the problem, buying expensive homes in a dropping market.
It's the classic shrink-to-grow strategy. It's risky, though. I mean, once you lose market share, it is notoriously hard to get it back.
It is definitely risky. But let's look at the real performance number here, stripped of all that debt noise. If we look at adjusted EPS earnings per share, and we completely remove that $933 million one-time charge, the loss was only 7 cents per share.
Negative 7 cents.
Right, negative 7 cents. And context is everything here, right? Because Wall Street was expecting A significantly wider loss than that.
Really?
Yeah. So operationally, despite intentionally shrinking their revenue, they actually perform much better than the street expected them to.
Okay, so just to recap the financial summary for you listening, the billion-dollar loss is mostly a strategic debt payoff, and the revenue drop is a deliberate attempt to stop hoarding bad assets.
Bingo.
That definitely clears up the whole disaster headline thing. But honestly, that just gets them back to neutral. It doesn't explain how they actually grow from here.
And that brings us to the core of the analysis report, Opendoor 2.0.
Opendoor 2.0, it sounds like a software upgrade, but we're talking about physical real estate here. What is substantively different about this version of the company versus the one that got into so much trouble in the first place?
The main difference lies in the mandate from leadership. The old Opendoor 1.0 was all about growth at all costs. It was a massive land grab, capture the market, worry about efficiency later.
Right. Very typical tech mindset.
Exactly. But Opendoor 2.0 is built on a totally different foundation. It's all about profitable unit economics.
That's a phrase that gets thrown around in literally every tech earnings call these days. Profitable unit economics. Does the analysis report actually show hard evidence of this, or is it just more corporate speak?
There is actual hard evidence in the inventory metrics. Let's look at stale inventory. These are homes sitting on their balance sheet for more than 120 days.
And in the real estate world, 120 days is the danger zone.
It's toxic.
That's when you start slashing prices aggressively just to get out of the asset.
Exactly. Now, in Q3, 51% of their inventory was stale. Over half their entire book was dead weight.
Wow.
But in Q4, that number dropped to 33%.
33%. That is a massive operational shift to happen in just a single quarter.
It really is.
That's highly significant. It means they are actually moving the bad vintage we talked about earlier. But what about the new stuff?
What do you mean?
Well, are they buying new homes? And more importantly, are they actually making money on them? Because if they were just selling old stock, eventually they just run out of product to sell.
They are definitely buying. In fact, home purchases rose 46% quarter over quarter.
Wait, 46%? In this market?
Yes.
That seems incredibly aggressive given how high mortgage rates currently are. I thought the new strategy was to be conservative.
Well, this is where the technology aspect actually comes in. The report credits this massive increase in buying to their new AI-driven pricing algorithms.
Okay, I have to be the skeptic here for a second.
Go ahead.
Every single company adds AI to their press release right now and just hopes the stock price goes up. What specifically is this algorithm doing that a human agent or even their old algorithm couldn't do?
It's all about granularity and speed. In a highly volatile market, pricing needs to be hyper-reactive. The report suggests that the new algorithm is allowing them to identify very specific micro pockets of opportunity. Yeah. Neighborhoods, sometimes down to the street level, where they can buy a home and with a much higher degree of statistical certainty that they can flip it for a positive margin.
So instead of a shotgun approach across a whole city, it's a sniper approach.
Exactly. And the proof isn't just in the AI buzzword, it's in the actual margin. The report highlights the newest cohort of homes, the ones bought specifically under this new Opendoor 2.0 AI model.
Okay. And how are they performing?
These homes are tracking to be the most profitable cohort in the company's entire history.
In company history, that is a bold claim, considering they operated during the absolute mania of the pandemic boom.
It is a bold claim. But the data they provided shows a contribution margin of positive 1% on this specific new cohort.
Positive 1%. I'll be honest, that sounds razor thin. If I'm an investor, 1% doesn't give me a whole lot of room for error.
It doesn't sound like much.
Right. I mean, if housing prices dip another 2% locally, doesn't that just wipe out their entire profit and then some?
In a traditional low-volume real estate business, yes, a 1% margin is absolutely terrifying. But Opendoor is a high-velocity, high-volume business model.
Scale.
Right. When you are flipping thousands and thousands of homes, a consistent, predictable, positive 1% contribution margin is the difference between blanking out and printing cash. It proves the unit economics are actually positive. They aren't losing money on every single transaction anymore.
Okay, I see the distinction there. It's really about proving that the machine works at all.
Yes.
If the machine reliably prints a penny every time it runs, you just need to run it a million times.
Precisely. And they've paired that new machine with extreme cost discipline. They've slashed fixed operating expenses down to just $35 million.
Wow.
The report notes they are heavily using automated workflows to replace manual labor-intensive tasks. They're running a much leaner ship now, so that 1% margin actually goes a lot further toward the bottom line.
So we have a cleaner balance sheet, a major cleanup of old toxic inventory, and a new AI buying engine that seems to be fundamentally profitable, even if those margins are tight right now.
That's the internal view, yes.
Right. But I want to shift to the external view now. What did the market actually think of all this? Because usually when a company posts a $1.1 billion headline loss, the stock just gets hammered and stays down.
The market reaction was honestly a psychological thriller in itself.
Tell me about it.
The section in the report on the market's verdict breaks down the intraday trading action, and it really tells a fascinating story of two completely different types of investors.
Walk us through that trading day. The earnings drop, the massive loss headline hits the wires. What happened?
Utter chaos at first. 9:30 a.m., the opening bell rings. The algorithms and the retail traders see $1.1 billion loss, and they immediately hit the sell button.
Just pure reflex.
Pure reflex. The stock panic dumped straight down to a low of $4.74. It legitimately looked like a liquidation event was happening.
That's the get me out at any price crowd.
Right. But then around 10:00 or 10:30 a.m., the dynamic completely flipped.
What happened?
The selling pressure just dried up, and massive institutional buying volume stepped in. The stock didn't just stabilize, it rallied practically all day. It ended up closing at $5 flat, securing a 7.5% gain for the session.
Wait, from a panic low at the open to a 7.5% gain in one single session. That is a classic V-bottom.
A textbook V-bottom reversal.
So what does that price action actually tell us? Who was stepping in and buying when everyone else was screaming to sell?
This is what technical analysts call heavy demand absorption. It implies that institutional investors, the smart money if you will, were actively waiting for that morning drop.
They wanted the discount.
Exactly. They likely read past the headline, understood the debt extinguishment strategy we just discussed, and saw the morning panic drop as a massive discount on a recovering asset.
So they were essentially buying the Opendoor 2.0 thesis while the retail crowd was selling the Opendoor 1.0 failure.
You nailed it. The report suggests that this specific price action signals that the weak hands have been successfully shaken out.
The panic sellers are gone.
Right. The people who were terrified of the headline loss have exited. The shareholder base has now rotated into people who are fundamentally betting on the long-term recovery. It suggests the market has fully priced in the absolute worst-case scenario.
That is a crucial lesson for anyone listening today. If you just reacted to the notification headline, you sold the absolute bottom. If you actually read and analyzed the report, you bought the opportunity.
It happens so often in these volatile stocks.
It does. But let's play the skeptic one last time here. We have firmly established they aren't dying. The bankruptcy risk seems off the table. But not dying isn't the same thing as thriving.
True.
The report mentions the road ahead. Is this stock still dangerous to own?
Oh, absolutely.
Yeah.
The analysis report doesn't mince words here at all. It clearly categorizes Opendoor as a high beta risk-on play.
High beta, meaning if the broader market sneezes, Opendoor catches pneumonia.
Right. It vastly amplifies broader market moves. And we have to be honest, the macro environment is still incredibly hostile.
The rates.
Yes. We cannot ignore that elevated mortgage rates are the gravity holding this entire real estate sector down. If rates happen to spike again, that positive 1% margin we just celebrated, that could vanish overnight. The housing environment is still fundamentally tough.
So they are essentially walking a tightrope right now.
They are, but they do have a solid safety net. Despite that massive billion-dollar debt payment, they still have nearly $1 billion in cash liquidity on hand.
That's a lot of runway.
It is. That gives them the ultimate luxury right now, which is time. They don't actually need to be wildly profitable tomorrow just to keep the lights on.
And the analysis report lays out a specific timeline for when they expect real profitability, doesn't it?
It does. The stated target is adjusted net income profitability by the end of 2026.
Okay, so we are looking at roughly an 18-month roadmap from here to get fully in the black. That brings up an interesting shift in tone that I noticed right at the end of the analysis. It mentioned a very specific shift from survival to scale.
That is arguably the key takeaway of the entire document. For the last 2 years, Opendoor has been purely in survival mode.
Don't go bankrupt.
Right. Don't go bankrupt. Pay off the massive debt. Sell the bad vintage homes. Stay alive. But the analysis argues that with this Q4 report, the survival phase is effectively over. They survived the storm. Now, the new question is, can they scale?
Meaning, can they take this new AI pricing model, which is clearly working on a small batch of new homes, and actually expand it back to the massive size they used to be without breaking the algorithm or losing that 1% margin?
Exactly. That is the new execution risk.
Yeah.
But the foundation, the setup, is finally there.
So to summarize for everyone listening, because there were a lot of complex moving parts here, let's boil it down. Why is the worst actually over for Opendoor?
It comes down to three main pillars. One, the financial disaster headline was actually a highly strategic debt cleanup that effectively removes future balance sheet risk.
Right, tearing the Band-Aid off.
Two, the operational pivot to Opendoor 2.0 is actually working. The stale inventory is dropping fast, and the new AI-priced homes are proving to be fundamentally profitable.
And the third?
Three, the market itself told us the bottom is in. The big institutional money bought the dip aggressively on earnings day, signaling they believe this turnaround is entirely real.
It is a very compelling argument.
Yeah.
It really forces you to look at a massive loss column completely differently than you normally would. But here's the thought I want to leave everyone listening with, and this is something the report heavily hints at, but I really want to explicitly state it here.
Go for it.
We talked about how they grew home purchases by 46% and managed to hit positive unit margins in this current market, this terrible high-rate frozen housing market. They are effectively training with incredibly heavy weights on right now.
Very heavy weights. The hardest market in decades.
So, think about this. If Opendoor 2.0 works right now, if this new AI machine can grind out a positive profit margin when the conditions are historically bad, what on earth happens to that machine when the Fed eventually cuts rates? What happens to their revenue when normal volume finally returns to the U.S. housing market?
That is the massive upside potential the institutions are buying. If they are this lean and this efficient right now, a recovering housing market acts like a massive hurricane tailwind. That tiny 1% margin could expand significantly, and the transaction volume could just explode.
Exactly. A lean, optimized machine operating in a fat, high-volume market is a profitability monster. But, as we said, they have to navigate the tightrope to get there first.
They definitely do. But for the first time in a very long while, the path ahead actually looks clear.
A truly fascinating look at a company trying to totally reinvent itself in the public eye. Thanks for breaking all of this down with me today.
Anytime. It was a great discussion.
And thank you for listening to The Deep Dive. Remember to always keep looking past the headlines, and we will see you next time.
Don't forget to like, share, and subscribe for more.